Hey, what's going on, everyone? Zachary Jensen here, managing partner of TaxWise Financial Services, where we're empowering small business owners with tax savings so they can grow with confidence. Today, I wanted to make a video about a question actually I got from a prospective new client, and they were wondering if you could actually use the short-term rental loophole on a portion of your primary residence. You could think of if you have an ADU, right, very popular in California, where you've got your main house and then the ADU in the back, or you've got a basement. Kind of what are the rules around this? Because the IRS doesn't want me doing the short term rental loophole on a primary residence. Obviously, that's a great way to get audited. But what if it's on an Airbnb that I'm renting out in my basement? How does that line get blurred, and what are the tax implications of that? So that's what this video is going to be about. I want to make that very, very clear for folks who are potentially interested in doing that. So first of all, real estate investors and homeowners alike are constantly searching for legal and effective ways to reduce their taxable income. And one very powerful strategy is the short-term rental loophole, which involves vacation rental homes. This tax strategy can be applied to a portion of your primary residence, such as the basement or guest house, under the right circumstances. And when you combine cost segregation with bonus depreciation, the short-term rental loophole can unlock significant deductions against W-2 income, and this is why it's so popular. Let's just do a quick primer on the short-term rental loophole. This refers to a special set of tax law under IRC Code Section 469. Generally, real estate is considered passive activity. However, if the property qualifies as a short-term rental and the owner materially participates in the business itself, then losses can be treated as non-passive and used to offset active income, such as wages or business profits. So to qualify for the short-term rental loophole, you need to rent out a property with an average stay of 7 days or fewer, or 30 days or fewer while providing substantial services like daily cleaning, meals, etc. Materially participate in rental activity. This means you're actively managing the property, handling guest communications, coordinating cleanings, and overseeing the operations yourself. The IRS has several tests to determine this material participation, but the most commonly used one is spending over 100 hours annually and more than anyone else in the activity. So we want to apply the short-term rental loopholes, but to part of the primary residence. The IRS allows you to designate a portion of your primary as a rental, so long as the space is used exclusively for rental purposes. It has its own entrance, privacy, and dedicated to the rental activity. So I want to just clarify that. It's got to have its own entrance, and it's got to only be used for rental activity. This could be a finished basement, in-law suite, or garage apartment. And if you use the space solely for Airbnb or short-term rental activity and meet the STR material participation rules, then the portion of your home can be treated like an investment property for tax purposes. So again, here are some key considerations. Exclusive use. The rental must not be used by you or your family for personal purposes at any time during the year. 2, physical separation. Have a separate entrance, bathroom, and living area, which strengthens the case that it is in fact a distinct rental unit. And no personal use. If you use the space personally, even occasionally, it may disqualify you from applying the full STR benefits. So when we actually go to leverage the cost segregation for the partial use of the property, cost segregation will allow us to take the normally depreciated across 27 and a half years residential property, and we can accelerate certain parts of it, like appliances, flooring, landscaping, up to 5, 7, 15 years, and in many cases in the first year, and it can be qualify for bonus depreciation as well, so creating even larger tax savings. When you apply cost segregation to a portion of your primary residence, you must first determine the portion of the home that's being used for the short-term rental loophole itself, and used as a short-term rental more specifically. This typically is based on square footage. So for example, if your basement is 800 square feet out of a 3,200 square foot house, then your home is 25% eligible, right? Because 800 is 25% of 3,200 square feet. If the home was purchased for 600,000 with 100,000 allocated to land, let's say the depreciable basis is 500,000, using 25% of the STR allocation, 125,000 becomes eligible for cost segregation for this particular accelerated process, and the study might reclassify, 40,000 of this to be shorter lived assets. And if you could use the bonus depreciation for 2024 at 60%, you could deduct $24,000 off your taxes immediately. So This is obviously very powerful, but we got to do it right and follow the proper rules. Taking advantage of this strategy requires documentation, proper tax filing, and you definitely want to have a professional take care of this for you. You have to track all the income and expenses related to the STR portion. You need to share the allocated expenses between personal and rental use in some sort of log based on reasonable methods such as the square footage. You need to file Form 5862 to claim depreciation, including bonus depreciation, and then, of course, maintain logs of your participation itself. So while this strategy is very, very powerful, it must be executed properly because the IRS is watching it like a hawk, and failing to segregate or meet material participation requirements could result in disallowed deductions or penalties or both, which would really suck. So make sure you're using separate bank accounts for your short-term rental income and expenses. Document everything. Use guest books and material participation logs. Use specific tax and accounting software to keep things clean, like QuickBooks. And most importantly, use a tax professional like us to help you implement the strategy moving forward. So a bit biased, but that's just how it is. So if you need someone that can help you with this strategy, feel free to reach out with us. Our contact is in the description below. Thanks so much for watching and have a great day.